Hey, all you cool cats and kittens, if you've watched the Tiger King documentary, as like a lot of people have. Uh, so I'm going to spend a little bit of time today going over your MarketWatch Journal assignments number 2 and number 3 with you. So let me go ahead and bring up number 2 here so we can talk about it. And there we go. Now, you'll notice on here, I've asked a lot of questions here. Remember, I wanted you to pick 2 consecutive weekdays where you made a whole bunch of trades, at least one an hour, and then a 2-week period where you made at least 1 trade a day. Now, that was what we call frequent trading. A trade a day is still considered pretty frequent. Actually, a trade a week is still kind of frequent the way this, the investors look at it. And I'm going to show you kind of the pitfalls of frequent trading. Now, since they were designed to do the same thing and I haven't done any trades, I'm just going to use as an example the price of Yeti stock over a daily trade period over 2 days, because it'll come out the same whether I'd done it for 2 weeks or not here. And I'm going to demonstrate this with you. So what I'm going to do here is we'll start answering the question, what was your net worth on Monday, March 16th, 2020? And let me just minimize this screen here. And I'm going to minimize it. I have a whole bunch of stuff open here. I apologize. Okay, this isn't what I want either. Here's the MarketWatch task number 2. I'm going to shift this over here. And I'm going to go to this document here. Okay, so I made a trade here, chart, for what I did on April 15th and April 16th to illustrate this. And I'm going to say I started off, my net worth was $50,000 on April 15th. You'll notice that the price of Yeti opened at $24.29 that day. The high price was $24.91. The low was $22.63. It closed that day at $24.54. And on that day at 8:30 at each hour, I bought 100 shares at $24.29. That brought my net worth to $47,561. At 9:30, I bought 150 shares at $23.18. That brought my net worth to $44,084. At 10:30, I sold 150 shares at $22.97 a share. That brought my net worth to $47,529.50. At 11:30, I sold 100 shares at $22.63 a share. That brought my net worth to $49,792.50. At 12:30, I bought 50 shares at $22.78 a share. That brought my net worth to $48,653.50. And then at 1:30, I bought 100 shares at $24.91 a share. That brought my net worth to $46,162.50. And then at 2:30, remember the markets closed at 3, so this is my last trade of the day. I bought 500 shares at $24.54, and that brought my net worth to $33,892.50. So on April 16th, I started the day, my net worth was $33,892.50. At 8:30, I sold 500 shares at $24.84 a share. That brought my net worth to $46,312.50. At 9:30, I sold 100 shares at $24.64 a share. That brought my net worth to $48,766.50. At 10:30, I bought 100 shares at $24.33 a share. That brought my net worth to $46,323.50. At 11:30, I bought 100 shares at $24.82 a share. That brought my net worth to $43,831.50. At 12:30, I sold 100 shares at $24.79 a share. That brought my net worth to $46,350. And at 1:30, I sold 100 shares at $25.56 a share. That brought my net worth to $48,856.50. And then at 2:30, I sold 50 shares, $24.89 a share. That brought my net worth to $50,101. So I made a tiny little profit, $101 over those 2 days. Not too bad for just trading one stock. I'd started out with $50,000. So what was my net worth on the first day? It was $50,000. On the second day, it was $50,101. And that was also would have been the answer to number 4 there. At the day 1, it would have been 50,000. 50,000. Day 2, 33,892.50. Number 7 at the end would have been 50,101. and we'll skip the 2-week stuff because, like I said, it's all going to come out to be about the same here. So in the interest of time, I'm just going to skip over number 9. How many trades have you made total during the game? We'll just use this as our example. I made 7 trades each day, so a total of 14 trades. If I multiply that number of trades by $10, I'd get $140, the answer for number 11. Now, if I subtract that amount from my net worth on April 2nd, and I write the amount below, that's going to come to 49. Well, let's just do the math here. 50,101. Somewhere I had a calculator open. There we go. So we'll say 50,101 minus 140. We get 49,961. So 49,961 is what I get on number 12. How many trades have you made during this game where you made a profit on the sale of stock? And I'm not sure on that. How much profit did I make in the game? We made $101. If we multiply that by 0.15, I actually have that written down here, then we would get $7,536.15. That's our capital gains tax. And if we subtract that from our earnings before the commission, what we get is we're now down to our taxable profit was $50,241 without the commission. We subtract the $7,536.15. Our net worth after fees and taxes, $42,564.85. So now we're into the meat of these questions and what they mean. Number 17, when you look at the amount of money that you made or lost trading frequently, what can you infer about how long your investment should be in the stock market should be? So how long should I leave money in the stock market? Again, one of the things I want to get across to you is investing is not gambling. You don't just go, okay, it's up, it's down. I'm going to place a bet on 33. Let's go 33. No, it is a long-term strategy investing is. And if you're trading hourly or daily, it's costing you money because the market is very volatile in the short term. It goes up and down frequently. And so you're probably losing more money than if you just held on and let the market work in the long run gradually build up. Plus, every time you make a trade, you have to pay commission. So that goes in there as well. So in the case of commission, I actually lost $140. I could have had $50,241 over that 2-day period. So that is actually how the answer to number 18. When you look at the effects of commissions on your trade, what can you infer about the amount of trading you should engage in? Very limited. When you look at the effects of taxes on your total net worth, what does that tell you about the amount of time you should hold on to investments in the equity market? The equity market's just another name for the stock market. Now, will I be taxed at 15%, that capital gains tax rate on any profit I make? Yes. But as long as I don't make a profit, in other words, as long as I don't sell the stock, there is no capital gains tax rate. So if I hold on to it for 2 years, you can divide that $7,000 by 2. I've now reduced my capital gains taxes due by 50% over the course of all those years that I've held on to it. So holding on to it a long time is just a very smart strategy. And hopefully you can tell that number 20 right below what revelations you've had regarding long-term versus short-term investing and a limited number of trades versus frequent active trading below. So I hope that helps you out with number 2. Now, if we go to number 3, this is where we have to do a little bit of math. And what I'm going to do is I just randomly chose a student, Cale Everett. So I'm going to look at his portfolio here to do the math here. So Cale, if you watch these, you get, apparently my screen sharing's paused. I don't know why. Resume share. I must have hit the wrong button there. Apologize. Okay, so we're going to, actually, I see why. A little flaw in the plan. All right, we're going to go to MarketWatch task number 3 there. We're going to close out number 2. Okay, MarketWatch task assignment number 3 requires us to do some math based on, when we're going to, like I said, use Cale. here as the example. So let me bring up Cale's portfolio here, and we will move this over here. Okay, what was his, and we'll just use his total net worth as of today for the April 6th. And his total net worth, you look at the right underneath his name there, says net worth $99,541.85. So that's the answer to number one. If we subtract $100,000 from that, we're going to get negative 400 something. Let me do the math here real quick, and we'll continue from there. 99,541.85 minus 100,000 equals 458.15 negative. That's his earned net worth, negative 458.15. Now, if we divide his earned net worth by his net worth, so we're going to divide this negative 458.15 by 99,541.85 divided by 99,541.85 equals, and we get negative 0.0046 basically. So that's his nominal return is negative 0.0046. Now we're going to take the earned net worth there, that negative 400, and I have to do the math again, I apologize. So we're going to go 99,541.85 minus 100,000, negative 458.15, and that's what we'll write that up here just so we don't forget it. Earned net worth is negative 458.15. Okay, and we're going to multiply that by 0.014. And we get negative 6.41. Negative 6.41. That's our inflationary loss. Now, if we subtract the inflationary loss from the earned net worth, which again was negative 458.15, negative 458.15 minus negative 6.41 equals negative 464.56. Negative 464.56. That's our inflation adjusted net worth. Now we're going to add 1 to your nominal return. And if you remember, the nominal return was when we divided our earned net worth by our net worth. So that's when we divided the negative 458.15 divided by 0 minus divided by our net worth 99,541.85, and that equaled, that was that negative 0.0046. So negative 0.0046. We're going to add a 1 to that. So that'll be 1.0046. So negative 1.0046 divided by 0.1014, which is the inflation rate, gives us negative 71.757. And we subtract 1 from that, that's negative 70.757. That's our real rate of return. Now, this is where we're going to take our nominal return, which is that negative 0.0046, I'm going to go over here to this scientific calculator. Minus 0.0046. And we're going to raise that to the power of 10. So 10 equals 22,026.47. 22,026.47. Whoops, put it on the wrong line. All right, that's the future value of our money in 10 years. If we continue to grow at that rate, losing that amount of money, our $100,000, or in Cale's case, what was it, 95,000 or $99,541.85. If he continues to lose money at this rate in 10 years, his account will be worth $22,026.47. Now, if we multiply 1.014 by the earned net worth, so we'll go 1.014 times, and his earned net worth was negative 458.15. We get negative 457.14 rounded. So negative 457.14. And that's our future inflationary adjusted value. And this is the assumed amount of the investment that you'll lose to inflation over the next 10 years if the inflation rate remains at these levels during that time. So he'll lose $457.14 in addition to what he was losing at the value of his account. So we subtract the future inflationary adjusted value from the future value then to get that. So 22,026.47 minus 457.14 gets us 21,569.33. So 21,569.33, and that's how much our investment will lose to inflation total over. No, I did that wrong. I apologize. So I say that number didn't look right. So actually, I need to go negative 457.14 minus the future value, 22,026.47, and that will give us 22,483.61. And that's how much we'll lose to inflation over the 10 years. We're going to lose more inflation than we have in the account, basically. So that's going to come out to negative 22,483.61. All right, now we're going to take the $100,000 we started out with, and we're going to subtract, and we're going to multiply that by 1.014, the inflationary rate. We get 101,400. Now we're going to raise that to the power of 10. So let's go back to our scientific calculator here. 101,400 to the power of 10. And we get, and then we're going to subtract $100,000 from that amount. 123. That equals 223,383. So this is if we did not invest the money, but rather kept it in a drawer. And again, I think I'm doing my math wrong. Let's clear this out again, and let's do this. So we're going to take $100,000, 123 times 1.014, $101,400. We subtract $100,000 from that amount. I think our scientific calculator was messing up. That's $1,400. And this is what our $100,000 would be worth in 10 years if we didn't invest it, but rather kept it in a drawer. In other words, at that inflationary rate, $100,000 is only worth $1,400. That's a big drop. Well, it's because we didn't raise it to the power of 10. So if we add another zero on there, then we're looking at, all right, let's start over on number 10 here. We're going to take our 100,000. We're going to multiply it by 1.014, which gets us to 101,400. We're going to raise that to the power of 10. So 101,400 to the power of 10 equals 223,348,631.60. And we're going to subtract $100,000 from this amount and then reduce it by the power of 10. And basically what we get is our $101,400 would lose about $22,334.84. So 101,400, so actually 100,000 minus 22,334.86. So our $100,000 after 10 years of keeping it in a drawer at that inflationary rate would only be worth $77,665.14. Sorry about the math. The way I have it written was kind of confusing even for me. That's something I need to clean up in the future, but that's what the math would come out to be. So number 11, based on what you have learned during this exercise, what should you do with excess money in the long term and why? And think about it for a second. Look at how much the money is worth in 10 years if you just put it in a drawer compared to how much you started out with. The value, you still have $100,000 in that drawer, but now because of inflation, $100,000 will only buy what $77,000 today would buy. So what should you do with it? You probably should invest it in order to keep that money at a value still worth $100,000 at that time. Now, number 12, should you choose to invest your money based on what you've learned here, what type of return on investment, ROI, should you be looking for? Think about it. You've lost $23,000 just by keeping it in a drawer instead of investing it. We decided in number 11. So what kind of rate do you want to get on your investment? You want to get a rate that matches or is higher than inflation in order to keep or improve the value of your money. Because if you're making less than inflation, you're still losing money. And that was the point of MarketWatch Journal assignment number 3. Number 2, the point was that investing is not gambling. It's not a short-term thing. It's a long-term thing, and that's where you get your best returns. And number 3 was that you have to beat inflation in order for your investments to grow over time. And so that's kind of the rate of return that you want on your investments, is something that matches or exceeds inflation to beat it. So those were MarketWatch Journals number 2 and 3. Hopefully this helps you out. And I will see you in class on Tuesday.